traders, welcome out to your currency midweek for December 21st. We are heading right into the Christmas holiday. Just wishing you and your families a very Merry Christmas, a Happy New Year, a happy holiday season for everyone out there, and just nice to be with you over the past year. We're going to talk about markets, but a lot of this is more personal in terms of, we get to sort of know each other, see the same names in class, and communicate via email and do some of those things, occasionally talk on the phone, but just a very happy holiday season. So, as always, a quick reminder to make sure that you follow your trading plan. And let's get to this week. And this week, it's all about the Japanese yen, isn't it? That is the big news story, not just in FX land, but really across the entire market. And a 4% one-day move higher in the yen. I've really tried to pound the table, and I feel like I've done my job. If anyone has attended these midweeks over the past few weeks, I've just been pounding the table that you have to avoid shorting the yen. It seemed like a ticking time bomb. And of course, this week that went off, and the Bank of Japan pivoted. They changed their mechanisms for keeping bond yields low, et cetera, et cetera. We'll touch on that more, but that was just a huge move in the Japanese yen, and it's probably not done. So stocks are in a bear market. They've been in that bear market. I'm going to change my tune a little bit, and this started yesterday. For anybody that really kind of looks at the equity markets and whatnot, there's a downtrend line that we've touched on in this midweek over and over again, and it's held and it's held, and it recently held. I'm now, not just because of that trend line, but a variety of different factors, I now expect that the markets are going to move above that downtrend line. And I think it's just become a point where we're going to move up and through it. So there's a little risk on period. The US dollar is significant. It broke the 140 level, and it was kind of a push below, kind of that fake move we talk about where it's like a trampoline. You bounce on the trampoline and the trampoline gives and it kind of pushes down and then springs you back up. That's what the Dixie did originally. We kind of spiked below 104. We spiked back above it a little bit for a trade. And now we're drifting back below. And the more you kind of stay here and consolidate, the worse for the dollar index. But I think it's going to be somewhat choppy. I think there was a trade for the bounce we talked about last week. At this point, I'm not super interested in trading a lot of things because volatility is going to stay there, but it's going to be choppy volatility. Volumes go away. We're moving. We've kind of missed the sweet spot at this point. From about today on, it's Christmas break, right? From today, I'm going to call it until the new year, the liquidity in the markets just kind of goes away. And so you have to be a little bit more careful. If you're going to trade the rest of this year, maybe consider taking down position sizes, doing some things that way, because you'll get some crazy volatility and some unpredictability really when you have low volume market environment. So the Japanese yen, I've touched on this the past few weeks. Now, I said it should run sharply higher in 2023, and I was calling it the next big trade. The next big move was the yen higher. It does kind of hurt that prediction in that we haven't even hit 2023 yet, right? But I still think it's making a kind of a secular shift. The point is, it's been left for dead. It's been heavily shorted. We've changed from QE to QT. Every other central bank has raised rates, and the Bank of Japan is left alone there. And they just had to relent. And once they relent and let up that pressure, it's reminiscent of back when the Swiss franc and the euro were tied together. Remember when they had basically tied the Swiss franc to the euro and they said, we're going to peg them. And once the Swiss National Bank basically relented, the Swiss franc went crazy Now, this isn't that big, it's not that dramatic, but it's still significant. It's a turning point, it's a shift. And remember that just like central bank hikes, if you were to look at a chart of interest rate movements of the Federal Reserve or a central bank, you'll notice that they go in trends. They'll be in a cutting cycle, and then they'll be in a stagnant cycle where they keep rates the same, and then they'll go through a rate hiking cycle. In other words, it trends in a certain direction for a while. The Bank of Japan has basically pivoted and relented, and what that means is that they're going to have to keep giving ground. Essentially, they're now in a rate hiking cycle in Japan, which a lot of people thought was never going to happen. I did not fall in that camp. I thought they were going to have to, they're seeing inflation like everyone else is, and they were going to have to give some ground. Now, I don't think that they're shifting to where they're going to start hiking crazy, but it's a major shift and it's not done yet. So, what did the Bank of Japan do? Well, basically, they've kind of pegged their interest rates down, and now they're letting them move by 50 basis points plus or minus the zero barrier. So they have central bank rates at zero, and now they're allowing that to move some instead of being kind of pegged in that level. So those are some changes that are taking place that again changes things in terms of markets. Now, interestingly enough, I am, and this is part of why I've had to change my tune a little bit on stocks. If you just told me that the yen was going to be up 4%, the Bank of Japan was going to make that change this week, my initial thought would be that the market, although it's not necessarily a game change, it just doesn't really matter. Like if the Bank of Canada raises rates, US stocks shouldn't collapse. If the Bank of England raises rates, the US stock market shouldn't care really, right? And so it's kind of the same thing. But I would have thought that there would be a negative reaction. There was in the futures. The Dow futures immediately surged down, and then as they should have done, they spiked back up. And it wasn't that big a deal. I would have expected maybe a little bit more selling in European equities and Japanese equities and some of those areas, specifically Japan, just because of yen carry and some things that way. But ultimately, this kind of tells you that the yen carry trade is not as big and not as impactful, which is a little bit of a surprise to me that maybe they've already been taking that down quite significantly because there just wasn't, the yen moved dramatically. Equities and risk assets and those things didn't move as much. Now, perhaps the yen carry trade is more seen in global central bank differentials, meaning that maybe the yen carry trade is to be short yen and long US government debt or something like that, where you kind of say, okay, they're going to keep devaluing the yen and driving its value down, and I'll make some money over here on the safest assets in the world. That, I believe, is what the yen carry trade has evolved into, is a much more safe. And you saw basically treasuries and things like that move more than equities. And so I think that's the correlation. I think that's kind of the what was moving on the back of that much more than stocks or anything else. In Canada, retail sales beat 1.7 versus 1.3. CPI came in a little bit hotter than expected with a 0.1% increase month over month versus flat, which was expected. But those are not problematic. I mean, an inflation rate of 0.1 monthly only translates to 1.2% for the year. So that's not a big deal there overall. And then in the US, consumer confidence boomed much, much better than expected. And remember what we've talked about, the consumer confidence numbers are perfectly inversely correlated to oil prices. I suggested that basically whenever oil has been dropping, consumer confidence has been rising and beating expectations. During the period where oil was spiking higher, consumer confidence was down in the dumps. And it's very interesting. And so what we've seen recently is oil prices moving sharply lower. No surprise, the consumer confidence numbers came in much, much better than expected. That is what the U.S. consumer is focused on. And when they're not paying as high a prices at the pump, they feel better about their situation and they're more likely to spend. If oil starts to spike again, then it becomes a little bit more of a problem. So lo and behold, look at what's happening in oil, up 4% this week. Part of that is the U.S. announcing that they're going to rebuy to fill up this strategic petroleum reserve. And I have to give the U.S. government credit. I would have bet against them, but they traded oil very well. They sold at higher prices. They're buying back at lower prices. Give credit where credit is due. I can't believe the oil markets cooperated as easily as they did for that, but you know, pretty pretty impressive. I worry that it's going to create a precedent that is problematic, where maybe the U.S. somewhat got lucky, and if the government thinks that they can continue to trade in that manner and control the markets, they may be in for a rude awakening in the years ahead. But for now, job well done. By doing that, they actually made the U.S. taxpayer billions of dollars, actually. Now, it could have blown up in their faces, but this time it worked out. At the rest of the markets, gold, crypto, a little bit higher. As we said, stocks a bit higher. Let's take a look at a few different things here and start with the S&P chart. So I really gave this a lot of thought here, and I probably should have backed this chart out a little bit further, actually. Maybe I'll just go live to a chart here. Let's pull up an S&P chart this way. I need to bring it over. The reason I'm going to do this is I want it to be a little bit longer so you can see the full spectrum. We didn't have this back here. And I've really been trying to make sense of what comes next. Now, I've been bearish, and that's been good. Yesterday, I really changed my opinion on the markets, and it's not just the chart, but the chart certainly plays a role. Number one, you know that there's this downtrend line. We've talked about it. We've been trading against it. It's worked perfectly. But I got to thinking, wouldn't it confuse and confound the most people at this point? Because this has become so obvious that now I think the pain trade is a move above that level. A move above that level triggers stop losses, gets people to say, what the heck is the market doing? How can it be doing this on bad news, on the economy doing this and that, and so forth. So the pain trade, I think, is a move above that trend line. That's bullish. Markets like to kind of go to the path that inflicts some pain and confuses and confounds, right? It's a little bit contrarian going against this longer term trend, but I think that's what's going to happen, and a few other reasons. This was an important gap area. We gapped up and we left that gap unfilled. We have now filled that gap as of yesterday, as of this week. So we had a gap fill. This pullback is also a 50% retracement of this advance. So if you use Fibonacci retracements, it's a perfect, 2 steps up, 1 step back, and now we push higher. Next, if you use Elliott wave or 4 stages of a trend or what have you, this was a massive exhaustion low. This was a huge bullish candle that kind of really pinpointed the end of this entire race. The race began back here to the downside, and this was the big grand finale. If you use Elliott wave, then by my wave count, I would look at it as basically this is one big wave. Let me change my color here. This is one big wave down. This is your correction, wave 2. This is the next leg down, wave 3, and it's usually the largest in size and so forth. Here's the correction, which is a wave 4. Here's the finish line, which is wave 5, right, with the big exhaustion. And then what I think, so we kind of corrected, and I'll go through different wave counts here in a second, but what I think comes next, usually if you follow Elliott wave, the ABC correction gets you back to wave 4. So what I'm actually thinking now is that this was the A wave, this is the B wave, and this will be the C wave. That's how I'm starting to actually think about this. So this is my Elliott wave picture of kind of the entire bear market downturn to this point in time. The pessimism, the nervousness. So everybody says, well, aren't we going towards a recession? Yes, that's why stocks were going down. Aren't earnings estimates coming down? Yes, that's known at this point. Everyone knows that the economy is slowing. Everybody knows that interest rates are having an effect. Everybody knows that economic conditions are going to be tough, that earnings are, et cetera, et cetera. So it's had a chance to be priced in. And this correction would really confound. If you wanted to go to shorter term Elliott waves, that's fine as well. You can kind of say, if you look at these, let me change the color. That's not a very good color to have show up. 1, 2, 3, 4, 5, right? So this entire wave was really a 5-wave pattern, followed by an ABC, 1, 2, 3, or something like that. This was maybe an ABC, and now you get the next push to the upside and so on. If you wanted to dig into all of these little moves, they're kind of 5-wave patterns, right, on a shorter term basis, followed by corrections and such. And so as we kind of look at this, again, I'm highlighting the big waves. This is one entire wave. Sure, it moved in maybe 5 waves down or whatever, but ultimately it was one wave. And sure, this maybe moved in 3 waves back up, ABC, but it was really just the second wave. And then the third and the fourth and the fifth, A, B, C. That's kind of ignoring the smaller waves, right? And just looking at the big picture. So this is kind of where I'm leaning towards, and I credit the Bank of Japan news for really emphasizing this point, because that could have been really bad news. Equities could have responded. They didn't. That's a telltale sign when you can trade higher on what would have, could have, should have been bad news. That's pretty good price action in an environment that could have caused them problems. So that's my thesis on the S&P 500. As you look at this week, I shouldn't say it's only the Japanese yen, because the other aspect to that is a big drop in the Kiwi. The Kiwi's having a rough week. Those are the two currencies moving. And to put this 4% move, I mean, it moved 4% in a flash. To think about that in terms of volatility, what does that compare to? Well, the reason that FX trades in pips is because it's a lower vol market. Let's say that USD JPY is expected to have a 10% volatility range for the year. And I'll bet when we were coming into this year, it was priced maybe right around that, maybe even 9% or a little lower. To put that into perspective, for it to move 4% in a day is about 40% of its expected annualized volatility. That would sort of be similar to the stock market moving probably, JPY moving 4% in a day would probably be like stocks falling 10% in a day. I mean, would that be noteworthy? Absolutely. It's just a gigantic gain in terms of its vol, its expectations, all those sorts of characteristics. So, crypto, I don't know what to say about that market. It's sort of been left for dead. You're still seeing this rotation happening, which is, I would say the Bitcoin, Ethereum may be holding up better than Solana, or, I mean, obviously I sort of don't even look at what was the other one that just absolutely collapsed. Um, well, maybe it was Solana actually, that moved 40% lower. So here we're looking at Cardano. Sorry, but I don't even have it in here anymore because it basically kind of collapsed and just left for dead. So with that, I mean, I don't think there's a lot of things to trade for the rest of this week. If I were going to look at certain areas of the market to kind of say, well, what makes sense going forward? I got the question from a few different traders. What do you think about the yen now? And I thank you for your nice comments and whatnot. What I try to do, I mean, certainly we try as best we can to kind of give our best expectations, right? And I don't get it right every time by any means, but this was a big one. This was maybe the most important trading call and kind of advisory, hey, be careful with this, that I could have put out there this year. So what comes next? I still think the yen is ultimately going higher. Now, the way that it looks after a huge volatility move, the most common occurrence is for some sort of consolidation, kind of body within a Harami type candle, right? And we've kind of done that. So you have this huge bearish candle, and then for there to be a little candle here that kind of fits inside or something, very normal. You're not going to get a pullback all the way back up to these moving averages, and frankly, that would be a bad sign if it did, if it had that much strength. Instead, I think you really have to look at this entire candlestick size and say, okay, if I split it in half and then I split it in half again, I mean, any move up here to, well, I would have said 83.75, which we already touched yesterday, or in that general area is basically the short zone. It's just not going, it's not likely to bounce much. It's probably going to have another wave of selling in the not too distant future. Now that's Kiwi yen, but if you look at all of these charts, it's the same picture in essence. Pound yen, euro yen, CAD yen, whatever, they're all kind of plummeting to the downside. And if you take any of these, it's sort of, again, that's the way I would look at it, is look at this entire candle size, cut it in half, cut it in half again, and you're probably trading against that zone. Just as it kind of hit here yesterday, today, that's really where you're going to be looking to short, is in that area. Expect some choppiness for a day or two, and then ultimately lower prices, in my opinion. So all of those yen pairs, with the yen spiking sharply higher, it's still a tradable area, but you probably look to continue to short it. And that's what I would be focused on here in trading. So I really don't have anything else other than kind of looking at those yen pairs. And again, I'm not super excited to trade the rest of this week. But if I were trading, I would just kind of keep picking away at those yen pairs and looking to short them as best we can. As we look at the rest of the markets, I mean, we've mostly passed the big things. We've got some GDP numbers out of the US and out of Canada for the rest of the week. Those are not expected to be market movers, but some things to be aware of. So for the rest of this week on the calendar, we have a currency recap we'll get out tomorrow. And then, of course, this weekend is Christmas holiday. Have a very Merry Christmas, everyone. We will be back. I believe we're holding everything live next week, so we should be back next week on Wednesday for the midweek. If that's not the case, we'll change the calendar, but I believe it's just status quo. And I'll see you all next week. Merry Christmas. Happy holidays, everyone. We'll see you next time. Goodbye.